know how to use volume in your trades? Welcome everyone to Traders of the World, our new interview show where we bring inspiring stories about the financial market and incredible guests. Hello world, good morning, good afternoon, or good evening, wherever you may be around the world. I'm Professor Flávio Lemos, chairman of the Brazilian local chapter of the CMT Association, also author of some investment books, and we are speaking English because we want this show to inspire new traders around the world. I hope you all like it and subscribe to our channel. Okay, I'm certain that we'll have an amazing conversation with our special guest. Speaking of our guest today, I'm honored that he has written my bestseller book, Forward. And he has made several presentations all over the world, including in our Expo Trader Brazil in 2007. Also, in 2007, his technical research was awarded the prestigious Charles H. Dow Award. Also, he is an award-winning author. His book, Investing with Volume Analysis, is the only book to win both the Traders Planet Star Award for Top Book Research, as voted on by end users, and the International Prestigious Technical Analysts Book of the Year Award, as peer-reviewed and voted upon by top industry experts. Also, he is the developer of volume weight moving average, the VWNACD, the volume price confirmation indicator, the VPCI, VPCI stochastics, the anti-volume stop losses, the trend chart indicator, capital weighted volume index, as well as host of cap weight volume based breadth indicators. His work with the market indicators and trading systems design has been published and referenced in Barron's, Stock and Commodities, CNBC, the Financial Times, and Active Trade magazines, as well as the FTA and MTA journals. So, guys, let's turn up the volume. He's a foremost expert in the field of volume analysis, founder of volumeanalysis.com, and chief technical analyst of Kingsview Asset Management. He has over 20 years experience dynamically managing private investment portfolios for affluent individuals, institutions, trusts, endowments, and financial advisors. In June of 2022, his volume factor risk overlay was named the winner of the Technical Analysis 2022 Best Special Product Research Award. He was also named to Forbes 2023 Best in Stake Wealth Advisors list. And now he has just launched a new book. So please welcome my friend, Buff Peltz Dormeyer.
Hey, thank you for that introduction, Flavio. Great to see you again.
Okay. Thank you so much for being here, Buff. So, Buff, tell us about your beginning as an analyst. What did you study? What did you work? How was the beginning?
Well, I actually started as a retail advisor, and we had this thing called a squawk box that sat in the corner, and it'd tell us, that the analyst would come on and tell us what stock stories, and then we try to take those stock stories and take them to the clientele to buy. The problem was that most of these ideas, they sat cold, they didn't move, and so those stocks weren't moving. Fortunately, there was one person that came on that squawk box, and his stocks seemed to always move, and he did something that the other analysts never did. Is that when the stocks weren't working, he'd say, "Hey, fold it. It's time to fold them. Time to move on. Let's find something that is working." And so I was just fascinated that this person could always find stocks that are moving, because that's what I needed. I needed stocks that were going up. And so one day I just called him up. I said, how are you doing this? And he just told me he was a technician. Gave me some books to read, referred me to the MTA at the time, which is now the CMT Association, and that's how I got into the technical analysis journey. And so as I developed my skills, one area I found that was volume. And everything I read said that, volume led price, and volume was all simultaneously provide reliability. I thought to myself, why isn't everybody using volume then? If I can get in a trade quicker and have a higher probability of it being in the position correctly, why aren't I using it? And so that's how I got into specifically the volume analysis.
Okay. Before we enter into technical stuff, you also have told me a funny story about firing your father. Could you share with the audience this story?
Yeah, so my like you, Flavio, my father works for me, and he does a great job at what he does, but I'm kind of greedy. I don't want to pay him the big bucks. It's just kind of a side job for him, and the human resources compliance person called me and says, "Hey, you're not paying your dad enough money." I said, "Okay, he's fired." And then I hung up. Well, a few minutes later, the compliance person called me back. My dad was in the room and he was stunned. But after a few minutes of silence, we both just started laughing. So my dad ended up getting a raise.
Okay, let's talk about serious things now. In your book, Investing with Volume Analysis, you said that most investors assume fundamental analysis preceded technical analysis. Do you think is it true?
That would be false. Yeah, so if you go back into the history of the markets, unlike today where we have high regulations, back then there was no regulations. And so basically all the information was contained by key individuals that had that information. And so as opposed to looking at access to balance sheets and income statements and all those materials, that they were largely closely held. And so because you didn't have that information, what you did is that you watched the people that had that information. So people watched the technicals because they were watching the smart money and what they were doing. And that was the way to invest. Then in the 1930s, regulation came about and made all this information public so that everyone can get it. And so prior to the 1930s, technical analysis was pretty much the game in town. And Charles Dow was pretty much the pioneer of getting that information out to the public.
And you said in an interview, volume is the force and the fuel of the market. But why a trader needs to use volume information?
I call these the 4 R's. So volume is responsive. Volume leads price. That simply means that generally before a big stock move, you see the volume change. Generally before an up move, you'll see big volume starting to build into before a big trend emerges. So you'll see the volume come in first. So volume leads price. And as volume comes in, and as that trend moves, let's say it's moving higher, more and more people confirm that price. Meaning as the stock moves higher, more and more people coming in is telling you that people are willing to participate in that stock at ever increasing prices. That is basically the fuel, or as you said, Flavio, the force that allows the market to continue to go higher. People with money is the fuel. That fuel is measured in volume. And so if the volume is confirming the price, not only did you get into the movement quicker because volume triggered first, now you have a more probability of being in a successful trade because that volume's confirming what's happening. And if you can get into a trade sooner and have a higher probability of being more reliable, you can reduce your risk because you're less likely to be in a false breakout or a false trend or momentum that doesn't have any fuel to substantiate it. So you can reduce your risk and you can increase returns because that volume is giving you a higher probability of success, and also generally generating a greater force to propel those prices higher.
I have interviewed recently Dave Keller, and he said that he does not use volume anymore because of the high frequency traders, dark pools, and hedge funds. But he still uses the Chaikin money flow and the OBV. But what do you think about it? This not using volume information because frequency traders, dark pools, and hedge funds?
Well, we're talking about individual stocks. There, there's dark and there's closed markets. But when it comes, and that generally has to do with price. But when it comes to price and volume, those markets are all lit, meaning that when someone makes a trade, whether it's in a quote dark pool or not, that information has to be reported very quickly within that, generally within seconds. And so it doesn't really matter whether it comes from a dark pool or not. It's really irrelevant to individual stocks. Now, the high frequency trading, basically that's just replacing what used to be the specialists and now the market makers. And so the high frequency trading really what they're doing is they're providing depth in the market right now. And so the only volume that we look at is on actual trades. So in order for a trade to happen, somebody that wants to buy has to meet somebody that wants to sell. And when those two parties come together, that creates price and its sibling volume. Price is what the price they agreed on, and the volume. So it doesn't matter where it came from. All that matters is that it's happening. And so volume, whether it comes from a dark pool or a high frequency trader, doesn't have any significance to whatsoever on individual stocks. However, what has happened in indexing is, I think, it's dark pools, high frequency trading. These are just mechanisms. But the real change in the marketplace was decimalization. So we went from fractions to decimalization, and that changed that made volume start to rapidly accelerate. So if you're comparing volume and say the volume has grown because of decimalization, and high frequency trading and dark pools are just tools that are made in between markets. And so it really doesn't have any impact. But what you do have seen is that volume has increased, and the volume on indexes was never really good or accurate. So meaning because volume was always tallied. And so because volume is tallied, when you look at price and volume, is what really matters is the relationship between these two. Okay. And with a price index, it's generally cap weighted, like the S&P 500 is capital weighted. We see that now with like the Magnificent Seven generating, 20-25% of all the movement of 500 stocks is cap weighted. But if you look at the volume totals, you really can't find, it's very difficult to find true S&P 500 volume. You might find the New York Stock Exchange or the NASDAQ volume, but it's really difficult to find the S&P. But even if you were to find the S&P 500 volume, those stocks, that volume is a tally of all the volume that happened between those 500 stocks. And what's driving that volume, those volume tallies, is the small stocks, okay, that are low priced. Those have higher volume than the big stocks that have high prices.
The penny stocks, you mean?
Yeah, it's the penny stocks that are driving the tallies. So in that regard, if you're looking at traditional volume and with indexes, I would agree that data is just about worthless because it doesn't relate to the price, and it's understating those big cap weighted moves where all the money's at, and overstating the small stocks where very little money is at. That's why we created the cap weighted volume, to repair all that.
Okay. So tell us about your new book, The Volume Factor.
So before I do that, let me tell you a little bit about my old book, Investing with Volume Analysis. Okay, so when I wrote that book, that was really targeted towards analysts like you, Flavio, that really understand the depths of the market. And the idea is that volume can be used as an indicator to create an edge to your portfolio management, an edge to your trading, because volume leads price, volume confirms price, and these produces less risk and more returns. So I go in depth in the book about explaining why volume, why volume is important, and how you can use some of these indicators to get these results. The second book is kind of a build upon that idea, but it's really for people that are more investment savvy, financial advisors. It's not for the analysts, because what we're doing is we're saying volume really isn't just an indicator. Volume is an investment factor. So what is an investment factor? A factor is a characteristic or a trait of a stock. And through various institutions and publications, a lot of it being the Fama-French model, they have proven that there are certain characteristics that certain stocks have that tend to outperform the market. Those would include technical factors like volatility. Low volatility outperforms high volatility. Momentum. Also some fundamental factors like quality and value. Those are some of the traditional factors. Okay. But the problem with these factors is that they come in and out of favor. So what I've proven, and the thesis of the book, is that volume is not just a data set. Volume is not just a stellar indicator that provides an edge. Volume is a factor, but not only a factor, it's the factor that rules them all. Because when you understand where capital is moving, you not only know what stocks to invest in, what markets to be in or out of, but also which of these factors are in vogue, so that you can position your portfolio in those areas that are currently garnering capital. And the results of this is that we can create investment goals-based investment strategies to lead to successful financial outcomes. So this volume factor is the missing piece for financial planners to build a portfolio that actually accomplishes their financial goals, which are to reduce volatility and create income for their investors.
Will you show us the book cover?
Sure.
And also, is it on sale right now, or is it pre-launch?
So book.volumefactor.com/pre-order is where you can get the pre-order information. So you can go to that link and just sign an indication of interest that you want information on the book. It's not a buying. You're not buying the book. You're just putting an indication of interest. And with that, when you do that, you'll also get information. You'll get my weekly volume analysis flash updates and volume analysis commentary. So you can get both in one shot. So you get the free volume analysis commentary plus the information on the book when it's released. And you may even get information on I got two, Flavio, I don't know if I told you this, but I got 2 ETFs coming up.
Oh, no.
That are going to be listed on December 18th. M,
Congratulations.
yeah. Let's see here. I think I got a slide on that right here. The volume factor global unconstrained, which is a growth portfolio, and volume factor dividend tree, which is a dividend growth strategy.
Okay, great. That's great news, huh? It's the first of the two, the first ETF like this.
So these would be the very first two volume ETFs, with volume being the catalyst or the portfolio driver for the strategies. And so let me just explain kind of what the strategies are. So the strategies are made up of three components. Okay, first, the strategy is made of three components. Okay, the first main components is everybody that follows sports knows that defense is what creates championships. So what we have in our volume factor strategies is we have a championship defense made up of a risk overlay that tracks capital flows. So one of my innovations was capital weighted volume and capital weighted dollar volume. Okay, I actually created this in the early mid 2000s, and I had two problems. One is I didn't have a software. I couldn't find a software program that could get it programmed efficiently. And then once I did, because computers were a lot slower back then, I couldn't compute the data to track how much money was moving into the stock market. Even though I had the formula, it took too long. It took like 20 hours to figure out how much money moved into the market, how much money moved out of the market, and what was the net. Now, with computers today, literally that same computation takes a second. So that's how much computers have evolved. So basically what I'm doing here is I'm following the flow of capital. And the flow of capital is trending higher and above trend, we are long the market. However, when the trend of capital turns negative, that's when we exit the market to preserve capital. Now, the goal here isn't necessarily to avoid daily fluctuations or even this most recent correction we had in the third quarter. What it's designed to do is to save the big money like 2022 to avoid that bear market. So like last year, we sidestepped the majority of the bear market because why? Because capital was moving out. When capital trends turned down, we exited. Okay. So that is the first piece of our portfolio, is having a really good defense. Now, the problem with good defenses, well, first of all, very few portfolio managers, very few investors employ defense. Okay, risk management is something that's really underused, especially by professionals. And financial planners would tell you, hey, you just got to write it out. Writing it out isn't fun. And when you're taking money out, and most wealth right now is in the distribution phase, meaning people have retired, they need their portfolio to live off of. If you're doing that and the market's going down, you're really, really hurting yourself. So you have to have a good defense to keep those losses low, to keep the volatility going, and that will keep you in the ball game. Okay. Now, of those strategies that do employ defense, they all have a common problem, is that they don't understand how to re-engage or transition from defense back to offense. So maybe they go defensive, but by the time they get back on their offense on the field, the big moves already happened, because the biggest growth of the market is generally in the birth of a new bull market. So when the bull market arrives, it arrives in a fury, and you see these big gains, some in a few weeks, sometimes even a few days. These are your big moves of the bull market. So what we use is volume as a tool, specifically the asymmetry between volume and price as a gauge of when to get back in. So let me give you, Flavio, do you know anyone that's always right?
My wife.
Right. That's it. That is the right answer. Your spouse, your wife is always right. Okay. So other than your wife, do you know anybody else that's always right?
God.
No. Marianne is always right, but you don't know anybody else.
God.
But
the market's always right.
The market's always right. Well, of course, the market. Okay. Now, but you work with a lot of different people. I'm sure you know some people that are always doing the wrong thing at the wrong time. You probably know several of those people. Well, there's a symbol that represents these people. That symbol is SPY. That is the S&P 500 ETF. And what this is it from price wise, the ETF moves just like the price, dollar to dollar, point to point. They move exactly in tandem. However, what this ETF is made up of is these people that are always doing the wrong thing at the wrong time, and that's retail investors. So retail investors are buying this spider. And so what I'm looking at is not the price movement so much, but the volume. And what happens during a bear market, particularly as it peaks out, the volume as the price drops will spike and it'll get super, super high. And that's what I'm looking for. That is the setup for the capitulation signal. And so what I'm looking at, if you can see my chart here, this is the mother of all bottoms, March 2009. And I was very fortunate to buy this spider, even some of my trades right on the very, very low. That was how I got it on the daily low. That was just working my trades throughout the day. But the reason I bought on that day was because I got the VPCI V bottom. And what the VPCI V bottom is specifically doing is it's looking for a catalyst of this volume surging, but then ever so slightly, there's fewer and fewer people willing to sell. And what does that tell you? It tells you all the greedy people that suddenly became fearful have already sold out. And now is the time to come back in when these people have all capitulated, okay? Doing the wrong thing at precisely the wrong time. So when you get that indication is by measuring the volume relative to the price movement through the volume price confirmation indicator, that gives you the signal it's time to come back in because now the market's capitulating. Another example here is in the S&P 500 during the pandemic. We got the signal on the 19th of March, the VPCI V bottom, which was 2 days prior to the actual low. And so that is the essence of what we're trying to achieve here. Have a great defense and then get back on special teams. And then finally is the offense. So the last piece is the offense. And what we're doing with the offense and what we explain in our strategies in the books, we're combining a couple different factors. We're combining momentum, we're combining trend versus a volume weighted trend. That's the VPCI. And then we're combining momentum contrasted to price volume momentum. Okay. And so by investing in stocks that shows good strong symmetry between their momentum and their price, or excuse me, their volume momentum. This is here the first decile stocks. This right here is the index. You see that has provided a much greater return, and when you combine them all together, you can get extraordinary returns.
So you showed the VPCI that you won the Charles Dow Award. Could you talk about it and other indicators? How many indicators have you developed? Could you talk about them?
Yeah, so the what makes the volume price confirmation indicator unique is that most volume indicators are looking at data sets that have to do with how much did the stock move today, how much volume did you have today, and it's looking at that on a daily or weekly or whatever kind of time frame that you're set up with. What we're looking at what sets the VPCI apart is that volume analysis is most useful. It's not saying it isn't useful in daily and weekly charts. It is extremely useful. But where you get the most value is in the trends, the longer term movements. So what we're doing is we're contrasting a trend, say a trend of a stock versus how much of that trend is attributed to actual money flowing in or out, okay? And that has to do with price and volume together. And so what we're looking at is the asymmetry. Is volume confirming the price trend, or is it lack of volume contradicting a price trend? So think about the market as like an airplane, okay? If you're flying an airplane and you want the plane to go higher, you're going to change the trajectory. But if that's all you do, that plane is going to crash, because in order for that plane to go higher, it needs also increased fuel or thrust. And volume is that fuel and that thrust of the market. More and more people willing to participate at ever increasing prices. That's the fuel. More money moving in, okay? So if the trend is moving higher and fewer people are participating, that's telling you that that plane or the market is subject to a stall. Okay. Similarly, let's just take the inverse. Now the market's moving down, and fewer people are willing to sell. Well, that's telling you, just kind of like we looked at the VPCI, that the market's in a state of apathy. Fewer people are willing to sell at these ever depressed prices, and is poised to move itself back up. So that's how we use the volume price confirmation indicator. But there are many indicators that I have developed. That is very unique. The newest one I have is the volume confirmation momentum indicator. Okay, that has even produced more stellar results than the volume price confirmation indicator, because it's not looking at just a price trend, it's actually looking at the momentum. And similarly, is the momentum sustained through volume? So that's just simply looking at the RSI, the relative strength index, and then comparing it to like the MFI, which is the volume adjusted relative strength index. So if you take the difference between those two, you can see that it is the volume momentum supporting the price momentum or not. And those areas of large asymmetry, I've found those give you just absolutely phenomenal results.
So the market is people in action, acting like people. So what's your personal trading routine? Do you have a checklist? Which tools do you use?
So the first thing I like to do is first and foremost is I want to know what the broad markets are doing. So that's my first thing. So if I'm in a bull market, then it opens up the game for lots of different things. But if we're in a bear market, then then it's going to close the gates on doing lots of different strategies. And so if we're in a bear market, maybe there's a few sectors. So then I'll look into the sectors. Where are we seeing in the sectors that there's maybe define the trend of the broad market? Okay. And if it's a bull market, which of these sectors, these areas are garnering the best place to be? This could also go beyond that into factors like, is dividends in vogue right now? Is quality in vogue right now? What traits that stocks have are in vogue right now, or styles like growth or value? Size, or the small ones, the big ones, the mid ones, which ones are garnering the most capital? So once I have that, then I can kind of narrow down, and when I see certain stocks, I know, okay, here's a stock that looks really attractive, but also its sector looks attractive and the market looks attractive. So if I got all three going, then that puts me in a good position. But with that said, Flavio, most everything I'm doing right now is algorithmic. I found that my own mind gets in the way, my own emotions get in the way. So most of the strategies I run professionally, I've looked at, they are just strictly data dependent. I've trained these systems on how to interpret the market, just like I would interpret the market through, and looking at these factors of multi-factors and putting them together, and how do they work together. And those algorithms, are better than what I could ever be.
AI at this best.
So I don't use any artificial intelligence. The greatest IA in the world is the stock market. Okay? And what I'm trying to do is, Buff Dormeyer is a person with limited mind, limited resources. But what I've figured out is, how do I find what the big money's doing? The big money can hire the smartest minds. They can buy the best resources. They can invest in the best research. And these people are the drivers of where that capital is going. So I'm not trying to outsmart these guys. I'm trying to follow the tracks that they're laying. And because I'm driving a speedboat and these guys are driving a big tanker ship out in the ocean, I can move much more quicker and nimbly than they can. I can see the directions and that they're going, and I can beat them to the spot. And so that is my advantage, is that I'm small, I'm nimble, but I know what they're doing.
This question we always ask it to anybody. What were your best and worst traits, and what have you learned with them?
So I think the best and the worst. The worst mistakes. I can't think of any names in mind specifically, but I'll tell you my worst mistakes is not realizing it. That is my worst mistake, is having a stock that I think I know more than the market, is not acting correctly, and I'm going down. Here I give you one. Big Five. Big Five is a stock that pays a really good dividend, has really strong free cash flow. Was a growing stock, growing its earnings, and it's cheap and like 5 times earnings. So it's cheap. It pays a really strong dividend. It's high quality. It's growing its cash flow. Everything looks good at it, right? But that was true at $20, and it's now true at $5. Okay, so my biggest mistake is not realizing that mistake earlier. Okay, and so that's why it's so important to have a stop loss. And so one of my indicators that I use is I call the anti-volume stop loss. And what it does is it adjusts a stop loss based on the price volume relationship. So if the price volume relationship is strong, I'm going to drop that loss lower that's going to prevent me from getting whipsawed out of kind of wild fluctuations. But if that relationship is weak, then I'm going to raise that stop, and I'm going to get out of that stock sooner should the momentum or trend falter. As far as my best things, one of the things I've just kind of already explained, one of the best things that I've been just very blessed and fortunate to be able to do is find these bottoms. You know, these VPCIV bottoms, people say you can't time the market, but I've been very good at gauging the market through these VPCIV bottoms. And we've been very accurate, not 100%, but statistics that people would say is impossible to time. So by gauging the market, looking at this data, I've been very successful in finding these bottoming points.
Does it work better on daily, or could you use in an intraday chart?
On the VPCIV bottoms?
Yes.
I use daily, but that's going to get you the quicker signal. The weekly I sometimes use the weekly to confirm the daily, but if you're going to get it to the day, you need to be daily. And I try to, those signals usually, if they're the good signals, usually happen within the week of the bottom.
But where the audience could follow your work on social media, and also could you suggest some good books as well as yours?
Some other good books.
Yes. Your Twitter or whatever you use.
Yeah. So one of the books that I really like, it's not a technical book, and one that you haven't heard people bring up, is I really like Quantitative Strategies for Achieving Alpha. That's by Richard Tortillo. And what he does, this guy's a researcher for the S&P. He's their researcher of, like, I think their index products, and he tests thousands of different factors or indicators for the markets. Most of them are economic and fundamental, but there's a few technical. And in one of the indicators that tests really, really well, matter of fact, the strongest of thousands of indicators indicators and data sets that he tested, was the relative strength index. Momentum is one of the factors that really show up strong in his work.
Okay. What's your website again?
So my name, buffdormeyer.com, is my main website.
Okay. My
website for my new book is volumefactor.com, and my old book is volumeanalysis.com. So buffdormeyer.com is kind of like the centerpiece. Volumefactor.com is specifically for the new book, and volumeanalysis.com is for the old book.
We will place everything in the description of the video. So, but what's your final advice would you give to younger traders?
So remember this: volume is the force. And just as Yoda went on an important mission and said, "May the force be with you," may the force be with you, and never leave your chart without it.
Buff Dormeyer, this has been an honor and a pleasure. Your technical expertise paired with a genuine desire to work in the best interest of your clients makes you a standout among our peers. We want to thank you, all of you, our viewers, for joining us on this journey today. So, your final words, Buff.
Hey, thanks for having me on. Great luck. Good luck with the podcast.
Okay. Well, we come to the end of this amazing interview with Buff Dormeyer. Thank you, everyone. We'll see you on the next interview. Bye-bye.